Good day. So, our discussion today is about the accounting cycle. And are you asking yourself that why do we need to understand the flows of accounting cycle? Or why is it important in business? Okay, let us start. So, as you can see, the modules that accounting cycle is a certain ways in order to fit with their company's business model and accounting procedures. This is the steps of accounting cycle. So the first steps is identify and analyzing the events recorded. Identify transactions is the first steps in the accounting cycle. Throughout the accounting cycle, businesses will engage in several transactions. Each one must be correctly recorded in the company's accounting records. The second step is the recording transaction in journal. It is the process of recording the transaction in the first book of accounts known as the journal. The transaction is the process of keeping track of all your business transactions in chronological order, so which usually includes the date the accounts you are crediting. The third step is the transfer to ledger. So the recording journal entries into the ledger accounts. So in this portion, accounting is basically a series of steps that are taken one by one. So after journalizing all the transaction, so it's time for the accounts to record entries into the secondary books of accounts. So that means if there are basically cash and capital will be like two tables in the general ledger, and the balance of the respective accounts will be transferred. So the general ledger basically they allow two accounts to get closing balance for preparing the trial balance. So the next step is the preparing the trial balance. So if you know, the trial balance is the source of all differential statement, and that's why special attention should be given to the trial balance. Now, from the closing balance of the general ledger accounts, and an adjusted trial balance is prepared. In this trial balance will be recorded on the debit side, and then the credit balance will be recorded on other side. So, then the debit side is totaled and the other side will be totaled, and the accounts will see both has similar balance, which is called tallying or tally the balance. In the trial balance is a bookkeeping worksheet in which the balance of all ledger are compiled into debit and credit accounts columns total that are equal. In a fifth step is preparing the worksheet and adjusting entries. So, worksheet is created and used to ensure that debits and credits are equal. If there is these discrepancies, then adjustment will need to be made. So in addition to identifying any errors, adjusting entries may be needed for revenue and expense matching when using accrual accounting. The sixth step is preparing financial statement. So there are putting the trial balance amounts onto properly formatted statement, adjusting income have made. So preparing financial statement. Also preparing information to the new investors that interested on your company. The seventh step is the adjusted trial balance. So an entry that occurs in a company general financial accounts at the end of the accounting year when a transaction begins in one accounting year and ends in another accounting year. These adjusting journal entries are recorded. So this will save the information. Deferred revenue, deferrals, expiring, calculation, as well as the events from the worksheet. So the eighth step is posting of closing journal entries. All adjusting entries must be entered in the journal and submitted to the ledger when the financial statements are completed. So all temporary accounts must be closed and the net change must be noted in the owner's equity accounts. The ninth step is preparing the post-closing trial balance. So before the new accounting period begins, the final trial balance is prepared. So the post-close trial balance is used to check that debits and credits remain in balance after closing entries have been made. So as well as to ensure the beginning balance are correct. The 10th step is posting of reversing journal entries. Reversing entries are made because accounts balances and prepaid expenses from the previous year will be paid off or used in the next year, and they will no longer need to be recorded as liabilities and assets. And that's all, and thank you for being with us. I hope you understand. Bye-bye.